In today's media, there's a lot of information about finance, the economy, and the stock market, but much of the information is misleading and sometimes an outright lie. This is because some in the media have ulterior motives. However, much of it is because people don't demand the truth. For me, I would rather have the truth, even if it's the harsh truth. But if you know me well enough, you realize that I don't generally give out harsh truths. I try to soften it, maybe a diplomatic truth. So today, let's go through a bit of diplomatic truth. And at the end, I'm going to give you some great advice for investing. Let's take a look. If you've been watching the stock market, you can see that it is happily marching its way back up to the previous highs. However, the bond market is telling us something different. The stock market, to me, is a comforting lie, but the bond market is the harsh truth. And as we can see here, the USTs, the Treasury, the 2s and 30s, the flattening curve is now down to 59.924. That's 59.924 basis points, the difference between the 2-year Treasury and the 30-year Treasury yields. And we've talked about the flattening curve before, so I'm not going to go into that detail. If you need some information, either go back and view some of my videos, or you can look it up on Google. But we have a flattening curve here. So let's go through some of these other charts to see where the flattening curve is heading. With regard to the previous chart showing the 2s and 30s, this is the first time since October 2007 that the difference has been under 60 basis points. And again, October 2007 was right before the great financial crisis. And this chart here showing the 2s and 10s, the difference is 42.244 basis points, and the yield has been flattening or declining since about early mid-April. Let's go to the next chart. Quickly here to the 5s and 30s, the basis point difference has declined to 30.867 basis points. And again, this has been declining since about early mid-April. Let's go to the next chart. And this chart here is showing the 10s and 30s, and the difference is 17.736 basis points, and as well this has been moving down since early mid-April. And another thing to remember is whether you're looking at the 2s, the short end of the yield curve, or the 30s, the long end of the yield curve, the story is consistent. And they're all telling you with a flattening yield curve that there may be some potential trouble ahead. And this is a composite chart showing you the various yield curves. And if you go back to the time frame of the year 2000, you can see here is the 0 line, and then the flattening of the yield and the negative yield curves, moving here into this time frame here, right before the dot-com bubble. They were telecasting problems in the market at this period here. Going into the year 2006, 2007, again, the flattening of the yield curves in this time frame, telling you that there's some problems in the market, again, right before the great financial crisis. And then here we have the yield curves flattening and a convergence of those yields. They're not down to the 0 point here, but still, they're telling me the harsh truth that there may be some trouble ahead. Now, this last yield chart here is different than the previous charts where we had a flattening of the yield curve. This is an increase of the spread between the U.S. 2-year Treasury and the German 2-year bond, the yield spread between those two. And as we can see here in the time frame of 1995 to 2000, right here in the year mid-1999, the spread reached this point right before the dot-com crash. And moving down into the time frame of 2005 through 2009, here in late 2006, the yield spread reached this point right before the great financial crisis. And here we find ourselves today back up here to that record level, at least going back to 1990, that yield spread again between the U.S. 2-year Treasury and the German 2-year Bund. We have a spread of 2.9849, and to me, this in a sort of inverse indication is telling me that there's some stock market trouble ahead. Now, let's go to some great investment advice. And lastly, from his book, Stock Market Profit Without Forecasting, Edgar Genstein has some great investment advice as follows. And let me read to you from the book. During major sustained advances in stock prices, which usually occur from 5 to 7 years of each decade, the investor can complacently hold a list of stocks which are currently unpredictable. He doesn't worry about the top because he knows he is never going to sell at the top. He knows that the chances are overwhelming in favor of the assumption that he will get far better prices by waiting until after the top is passed and a probable reversal in trend can be identified than he will ever get by attempting to anticipate the top and get out on the nose. In my own experience, the largest profits we have ever taken have come from stocks purchased while they were making a new high in a market which was also momentarily expecting the top. He continues here. As I have already pointed out, the absolute price of a stock is unimportant. It is the direction of the price movement that counts. It is always probable, but never certain, that the direction of the price movement will occur. Soon after it reverses is time enough to sell. You should sell when you wish you had sold sooner, never when you think the top has arrived. That way you will never get the very best price. By hindsight, your individual transactions will never look daring, but some of your profits will be large, and your losses should be quite small. That is all that is necessary for a satisfactory, enriching investment performance. So for today, that's ChewDog Charts. Thank you.